Hey, yo, what's up, Outliers? So today I want to talk a little bit about this whole banking thing because I think it's actually really interesting to see the way that the market reacted. And as always, there's a tradable opportunity here. So I want to talk about what happened specifically in Zion. The other name that you'll see in here is Western Alliance Bancorp, but I didn't trade that one just because it's a little less on my radar. Zion had popped up on a intraday scan as it started to absolutely fall off a cliff. Now, the interesting thing about this is this move blends beautifully into earnings. These are some of my favorite earnings plays when you have this massive catalyst before the earnings release, because there typically is a way dampened move post ER. Now, sometimes it could favor a return back to the prior side. I think that might not be in the playbook for Zion's, but we will see. What's up, Finn? Finn says, good evening. Enrique, that's my Puerto Rican name, in case you guys didn't know. You stand up chap. Kind of weird to have Enrique, my Puerto Rican name, and then chap. I thought those would be a little more on brand, but I'll still take it. Do you have some insights into the upcoming Jimmy Bone home? Yeah, we can take a look at that a little bit later. The overarching thoughts on GameStop is it looks to be leveling off. So we can definitely take a little time looking at it later, get a little more detail. But with respect to our favorite bone cone, it doesn't look super primed yet, to me at least. Maybe. Can always be delightfully surprised. Now, for those that monitor the market a little more closely, I'm genuinely curious, did you guys see this news or did you not? I'll throw a poll in really quick. I'm curious. So this is regional banking. I want to get a sense of how this permeated. So I'm essentially just asking, did the regional banking thing even come across your desk? Is it something that popped up on an alert? So far, it looks a little tilted to yes, which is good. That's kind of what I would expect to see. A couple more no's than anticipated. Broadly, yes. Okay. So to then give a really, really quick preamble, there were two banks specifically that highlighted some weakness in their loans. And the funny thing is the way that it was perceived. Reggie says, didn't hear about the specific bank, but heard about the stress in regional banks. That's the part I'm fascinated by, because a lot of people heard that exact part, specifically the distressed, the crisis in the regional banks. And this actually, to me, affirms and highlights an insane sensitivity to banking. And a lot of this comes after what we saw in SVB. I think after Silicon Valley Bank got essentially crushed, everybody now is, which is also, by the way, after the 2008 crisis, I think people are very, very, very sensitive to the banking system. So what ended up happening here was two different scenarios, but they happened around the same time, or they were announced at the same time. And you can see Arjun says it's because the accounting profession has become a joke. Is that accurate though? I genuinely don't know. I don't know much about the accounting profession. I don't know what the perception is. If it is something that's strong or not. I always thought accounting was pretty prestigious and decent pay there. But like I said, I literally don't know. I think at least with these, one of the things I picked up on was fraud. And that's a little more difficult, I think, to work with. Now, it seems like Western that they had enough collateral that they're not really super worried about it. But Zion looks to be in a slightly different scenario and actually entering a lawsuit regarding the seemingly fraudulent loans. It's a little early to say. So let's see what this says. And I just want to talk about the way that the options market behaved around this. It was absolutely fascinating. So we see Zion stock dropped 8 points after I was going to say it was the California bank and subsidiary. I was wondering because it said Salt Lake City Bank. Take 50 million charge off in the third quarter for 2 commercial and industrial loans originated by its California bank and trust subsidiary. The loans totaling roughly 60 million were reportedly extended to funds who invest in distressed commercial mortgages. Those businesses are now facing legal action. Zion has filed suit in California to recover funds, claiming its collateral was transferred to other entities without authorization. Can't do that. Like if you have a piece of collateral that's tied to your business, that's now tied to a loan to your business, you can't move that collateral without communicating that and discussing it with whoever has originated your loan and essentially moving what you're securing it with. Agent says Apollo Group involved. Enough said. I don't know much about Apollo Group either. I'll look them up. I'm actually really curious if this is like an accounting thing or something else. Like I said, I genuinely don't know. I just saw the price movement and then I saw the market reaction and then I saw the vol in the financial sector, and all of that is what really drew my attention. But when I was reading a little bit more about it, I got really, really interested because these are the really interesting artifacts that I think my brain has gotten primed to be interested in the things that tend to lead to opportunities. Because that's exactly what this is. There are opportunities as a result of this, depending on how it goes, but nonetheless, volatility is a big piece of this all the same. Okay. Phoenix-based Western Alliance also disclosed exposure to the same borrowers and said it initiated legal proceedings in August against Cantor Group V, LLC, alleging the company falsified title documents and diverted funds from pledged accounts. Western started in filings that its collateral position remains sufficient and reaffirms 2025 financial guidance. So this is exactly the broader issue. The fact that both of these occurred around the same time is what led to the market reacting the way it did. And again, as we look at the initial move and then more importantly, the subsequent move, because the subsequent move, I thought, interestingly enough, this wasn't that bad. This was quite stabilizing. So if we take a look at Western, about the same exact behavior. And then if we take a look at regional banking, almost the same exact behavior. Now, from a trading lens, there's a lot that can be done here, which I'll talk about. Arjun says commercial real estate is a disaster and they've been hiding it somehow. That I wholly disagree with, just because I'm involved in commercial real estate. It's a literally booming business. I think a lot of people mistakenly will broadly say something like that when they're referring to things like office spaces, because there definitely are pockets of commercial real estate for sure that are distressed without a doubt. But as a broad industry, commercial real estate is extremely, extremely strong and stable, as per usual. A lot of it has to do with the way that they're structured and the way that they do business. Because, for example, if you run rent for a manufacturing building that's built and tailored to some sort of manufacturing process, whoever comes in as your renter and sets up their business there, they're kind of setting up shop. They're not looking to move. So you actually have like really, really stable tenants that take care of the place because they work out of there and that kind of stuff. It's just a super simple example. There's a ton of them. Perk says industrial and multifamily are killing it. Yeah, you can go through the subsectors because, again, like I'm involved in some ski resorts and those tend to continually perform well. Apartment buildings that I'm in are doing really well. Golf courses are still doing very well. New developments. There's actually a new project that I'm working on with a couple business partners for like a new build. That is also looking really good. So there's a lot to it, and commercial real estate is just a really, really big, it's huge. There's a lot of subsectors, just like the stock market. In the stock market, at any single point in time, you guys see something doing well or doing poor. There's always something doing the opposite, like just about always. For example, when I look at staples are still not doing great. And they've not been doing great for some time now. Yet we still see comm services hovering near highs, tech near highs, industrials near highs, healthcare has also strongly rebounded, and then utilities. So there's a lot of strength underneath the surface in the broad market, even though there are still pockets of weakness, again, that you can find in staples. And then even the financial sector, I think last week scared a lot of people. It's an acknowledgement of how profound the financial sector is and what kind of cascading impacts it tends to have, which are literally profound. More often than not, you'll see small things like this start, and then the fear here is how far does this spread? How many other banks did deals with this group? Because if this group specifically is involved with other banks, they obviously won't have enough collateral, which is kind of nuts. That goes into the broader fraud and fraud redemption. So let's see what this says. It says the optics of a large balance C&I loan to a fraudulent borrower from a bank that specializes in small C&I loans is not great. So completely true. It's kind of like if you have a race car driver say like, hey, do you want to go for a spin? But they crash a lot. That's a problem. You probably don't want to go for a drive with that race car driver. If this is what they're supposed to do and they're supposed to specialize in, this kind of thing should be exceedingly rare, if not occurring effectively. In a client note, it says it puts into question Zion's underwriting standards and risk management policies, which is completely correct. Let's take a look at the options market, which is pretty interesting here. And again, focusing a little bit more on Zion, just because it's a little deeper inside my tradable universe. On this initial drop, could trade it directionally. I didn't. I saw the move happened and was just kind of sitting by, seeing what was going to happen. And then I ended up trading vol. So just trading really, really near term last week, trading everything I could in the front to essentially play the expected narrowing of this range if there wasn't a continuation, which was really based on the following day, the 17th. We take a quick look at the options chain itself. Let's go to here. The question I always have is, did somebody know about this ahead of time? And was it forecasted? Which it doesn't look like it. What I see here is before the drop, which was on the 16th, we don't really see any weird behavior in the stock. We do see a little strange behavior in the underlying here, but this is just from a close to an open print. That's why there's that massive decline, because it attaches the 2 days, which really it shouldn't. It's a little confusing, but that's what it does. Then on the day of, there was an insane amount of put purchases, which again makes total sense. Here's the thing that I do find interesting. What you notice here is as the underlying is plummeting, people are buying and buying puts, more and more long puts, trading it to the downside. All of a sudden, it completely reverses from here to here. Between this time frame, completely reverses. This is the 11:30 to 11:45 handle. The long put premium here was about 790,000. Here, it's now short 500,000. The reason why it has that profound of a shift is because this is the people who are buying these puts starting to unwind the put position. They're taking it down for a profit. The thing that I find slightly anomalous here is the fact that this is not pure bottom tick, but pretty damn close to bottom ticking it, to catching this bottom. It was off by, 30 minutes or an hour? Not off by much. That is more interesting to me than anything else. This kind of, and it front runs it ever so slightly. That I can't help but be really, really curious how that functionally occurred here. Is that players being in communication with one another and kind of saying, yeah, we're not seeing the order flow stacking in as much as it was, and now we're just going to take profit and move on? Really hard to say. But what gets even more interesting to me is it starts to spike again, but this time it's into the close. So this almost looks like an expectation of a continuation to me. But the total premium on the day was just about flat, which is kind of fascinating. It's a really, really strong short-term show out to play that thing to the downside. Arjun says industrial maybe just for data centers. Multifamily is hardly killing it now. Rent's dropping. I don't know if that's true. Let's see. And let's zoom this in to like a year, 5 years. I mean, that still looks fine to me. And let's take a look at this. Second consecutive quarter rent growth softened. So I think that's Arjun's point, which absolutely looks correct, coinciding with weaker job growth. I think job growth is tricky because unemployment is also so low, though. So it's not like weaker job growth is bad. I don't really think it is right now, actually. In response, most owners adopted more defensive leasing strategies focused on preserving occupancy rather than growing rents. Yep, I agree with that. Become a priority that rent growth in the third quarter fell to levels last seen at the onset of the pandemic. Rent growth. Okay, that's okay. That's not obviously saying that there's an insane amount of demand, but that also doesn't look bad. And if we take a look at the average rent, it's just kind of stabilized. It's not really going anywhere. It's still hovering around the 1900 handle. So I don't see that. I think multifamily seems to be doing quite well. So I'm not sure, Arjun, what you're looking at. Might be something different, but yeah, that doesn't look bad at all to me. Kirk says, is that premium graph a real-time graph, or how long does it refresh during market hours? I think this is real-time. It tracks the net premium. I don't know what the actual delay is. It's obviously not going to be like absolute near time, but yeah, it updates throughout the day. I don't sit there and like watch it because it's still 15-minute candles on longer-term time frames. Let's see what it is for a day. Yeah, so it looks like it updates every minute. on the day. 2 days takes you out to 5 minutes. 3 days is a 5-minute candle. 7 days, 15 minutes. And then 14 days is 15 minutes. I normally use this kind of thing just to help me identify things that look interesting, stuff that's behaving strange, stuff that is starting to spike. More often than not, what I do is I get different alerts throughout the day. Stuff based on premium levels, stuff based on sweeps, like excessive volume over OI on expensive trades. All of those kinds of things, I get literally alerts throughout the entire day. Then as I come across ones that are interesting to me, I use this kind of view, specifically like a slightly longer term view, like 14 days, because it gives me context. When I am this close in, I can see that this is high, but I have no idea if this is actually really high or is this super low and this super low, just in terms of the put premium. I have no frame of reference. I have no idea, which is why I typically default to like a 17-day or a 30-day window, because now I absolutely have context that this is insane for this kind of thing. If I look back over the last highest version, which is here, the total net put premium was 123,000. So this is 8 times the prior high. That's informative to me. That tells me that something anomalous is occurring. Just like Ewan Sinclair in the podcast that I did with him, I think it's a really pertinent point to reiterate, which is a lot of what we do in trading and as traders is just look for shit that's weird. Look for stuff that doesn't look normal. And sometimes people will say, well, like, how do you know what's normal or not? That's built over time. That's context. Think of something that you do, anything that you do, and think of somebody that if they came in to do what you do, but it's the first day of them doing it, you could probably see a lot of artifacts that look weird about what they do. It might be the way that they type. It might be if you play some sort of sport, or if you like jujitsu, or you like fighting. It might be that they don't have a proper stance. Big thing that I dealt with that is anytime that I would switch from like mixed martial arts training and boxing is very specific in terms of stance. And you have to be really good at keeping your elbows tight, which is kind of funny because my body doesn't really do that well. Anybody that saw me boxing would immediately know I am not a boxer. You could see it from miles away, not a boxer. It's the same thing when you look at markets and you use tools like this. We're looking for anomalous stuff. What's not normal? And then is there a potential idea off of it? Which, as we were talking about with Zion, there's a couple really simple ideas. The first one is implied volatility percentiles at 97%. If the thought here is we think the move is done and we think Zion is stabilized, then we can play it a little bit more to the upside, which is actually what I did. I have a short strangle in here, but I have it skewed to the upside, both in terms of delta and in terms of lots. So I will show you. I wonder if on demand actually goes back. Let's see if we can go back. I don't know how far back in time it'll let us go. It'd be cool if we can actually trade the day though, so I can show you. We can, damn, we can only go to the 16th. Nuts. Let's see. This is actually a good proxy. Let's go to the 13th, because the 13th is kind of like not the same, but not that different of a proxy for what happened here in terms of the way that it's going to behave. And then I can show you how I traded on the 13th, which will just be a proxy for how I traded yesterday. Actually, super similar, not exactly the same. The vol pricing and stuff like that is going to be a little bit different, but it won't be massively different. I don't know what caused Zion to sell off here on the 10th. I didn't trade it around here. I'll see if there's any news that goes back. Not really. Yeah, the news came out on the 15th. So let's take a look and I'll show you. The scenario, again, is not all that dissimilar to the recent sell-off. I just want to show you like an actual option trade that can behave how it behaves around something like this. In this specific scenario, there's a big red day preceding right before the entry day. What causes it? Again, don't know in this scenario. Doesn't really matter as long as it spikes volatility and it distorts price, which is exactly what's happened here. Then we can see price is starting to stabilize. This is still a really high risk play. The probability of getting stuck in a suboptimal move is quite high. But let's take a look. If we go to 21 Nov and we just eyeball pricing, one of the things that we can do is get a sense of both delta and vol, how things are being priced. So I will create a little calculator thing here for us. Relative delta and IV. What I'm going to do is I'm going to input a strike price. We'll start with the spot price. Spot price, strike price. We want strike 1, premium 1, IV 1, strike 2, premium 2, IV 2. This will allow us to compare two different things. And these will all be inputs. I want you to see this the way that my brain sees it. If I'm going to move it out of the way just so I can input this stuff a little faster. Right now, the price is 53.79. That goes into the spot price. Let's take a look at the 50 delta put, or I'm sorry, the 50 strike put. Oh, I forgot I need delta. That's why I was mentally saying delta. I'm adding 2 more rows for delta. We need a D1 and a P1. So delta 1 and then delta 2. Cool. That's 50 is a 0.272 delta. Premium for that is $1.30. Implied volatility for that strike is 40.8%. Now let's take a look at the 30 delta closest we can on the call side, 57.5. Delta on that is 0.302. Premium, $1.15. Implied vol, 35.7%. Okay. Now I will show you what you can do with this. What I can do is I can normalize. I'll zoom in on this for you. I can normalize for these. In this case, the first thing I'm going to do is create, probably a little better over here so we can have another row. I can create some things relative to spot price. For example, I can just see what percentage of the spot price we are. The reason for doing something like this is it will allow me to calculate on a same basis between these. So for example, this divided by this. Really, if I would have to modify these formulas so that it does, if it's above, do the inverse kind of thing. It's still effectively same, doesn't really matter. What I can do here is I can eyeball how far off either of these are from current spot price. This is 7% higher-ish. This is 7% lower. These are about the same in terms of a distance from the current spot, even though this has a lower delta. That tells you something right out of the gate. The fact that these two are effectively the same percent off from, or the same, I don't want to say off, but the same percentage of spot, but they have very different deltas, tells us a few things. The other thing that we can clearly see is that there is more vol on the put side. We can see that represented right here. It's effectively 5 points of vol higher on the put side for a lower delta. What that means is there's an interesting opportunity for short puts. Let me clear out whatever's in here. Yeah. The way that we can trade this is by setting up this kind of skewed strangle. I'm going to do it as 2 individual trades just because to skew it, I need to use different trade sizes so I can moderate my total delta exposure. Now I have both the calls and the puts, and we have a very familiar looking P&L plot of, I guess I'll zoom in a little bit, of an iron condor. Kirk says, how many hours per week do you watch charts / trade during market hours only? Those are 2 very different things for me because I very rarely sit and watch charts at all. And it's because I purposely set most of that stuff up via alerts. What that means is I will get different kind of things that pop up on my screen. And it's because I know I'm not a chameleon and I can't look at everything that I want to see. The way that I trade isn't really based on day trading like levels like some people do. That's another thing that takes a tremendous amount of screen time. So I spend very, very little time doing that. Now that's a completely different function than how much time like looking at the market in general while it's open. Most of the time when the market's open, if I'm looking at the market, what I'm doing is looking at the string of alerts that I've gotten. And then I'm doing this other style of analysis. Like I will peek at the chart just for context, but then I'm typically going straight into the options chain because I can get way more information out of an options chain than I can out of a chart. That is the lion's share of the quote unquote analysis that I might put in. In terms of time per day, it really, really, really ranges depending on the day and the week. There were times, especially when I was first learning to trade, that I would literally spend as much time in as humanly possible. I distinctly remember in college, I would have a laptop and I literally would have the market open and I would pay way more attention to the market than some of the classes. Some of the classes were legitimately good and I would pay attention in those. A lot of them were not. So I would not pay as much attention in those, and I would happily just spend time looking at markets, looking at options chains. So it varies a ton. It can be anything from 2 minutes, because I do trade just about every single day, but sometimes it's very, very brief. If I'm doing something and I'm putting a position on that is just going to sit on, could be, 2 minutes, or it could be hours. Really depends on what's going on. More often than not, it's on the lighter side. There's so little for me to do when the market's open in terms of like analyzing stuff. Almost all of the analysis that I do is when the market's closed, and then it's a function of validating when the market's open. And it's just because the stuff that I do isn't quite that time dependent. Again, it's not really like intraday trading individual things. The stuff that ends up taking more time are kind of like the example that I was sharing not that long ago with a couple things that had big intraday down moves that I traded those intraday. Or when we had the the newest round of tariff news come out, and then that big intraday drain. Those kinds of things I will absolutely spend more time looking. And it's just because there's more opportunity. So yeah, super, super variable. All right. Now let's take a quick look at how this skew works. If I were to start with a base position of a 30 lot each side, I could have just typed it in, but I kind of am committed now. We have a 30 lot each side. That puts us at about 10 grand of risk. If I wanted to create a specific skew with this kind of thing, with an expectation of it rallying or at least not plummeting, and wanting to capture more of this, specifically this variance in vol, that kind of thing can be done via a skewed short strangle. The way that I can skew this, I can say, well, for my put side, rather than 30 lots, I'll do 50 lots. The way you choose the skew that's most applicable to you depends on where you see the risk and how you intend to manage the trade. That gets into like strategy specific stuff. But the main thing that I want to show you is based on the strangle that I have right now. If I add one more row to these so that I can show you composite metrics. So this will be lots, and this will be lots. Here we said we have 50. Here we have 30. I can now show you what my total deltas are. So we have 50 lots times our delta times 100. 1360 is what we got here. And then if I apply that same math here, we have 906. Our net deltas on this position are 454 long. We're long 454 deltas. The question here is that the correct number of deltas? Is that what we want? For something like this, that completely sufficient. You can figure out whatever ratio you're most content with. For example, if I want to figure out my long to short ratio, I'm effectively 1.5. You can pick, again, whatever ratio makes sense for whatever your specific scenario is. Anything based on the skew, though, should really focus on whatever the directional tilt is. If you don't really have a strong directional tilt, then you don't want to go too far, because now we've increased our downside risk to 16 grand and our upside risk has come down to like $6,700. And again, you can size this stuff down. I'm just using something with slightly larger numbers to make like the total deltas and stuff stand out more. If you were to size this kind of thing for a $100,000 portfolio, for example, and you were to size it at 1%, then that means that you get to risk about $1,000. That would cause us to shrink all this stuff down pretty significantly. If we were to risk $1,000, you could effectively get away with a 4-2 or a 3-2. That's essentially what you can squeeze out here. Now, let's go back to the slightly larger size for now. And then I want to fast forward a day so that you can see how this behaves. We'll go forward a day, and then we'll go a little bit later in the day, 12:30. Arturo says, any word on BYND? We can take a look. I haven't really I haven't really looked at it lately. Let's take a look at what happened in our trade. Our P&L right now is up 1254. Notice how our upside risk has actually gone up. Before, if you'll recall, it was $6,000. Now it's 11.5. Who knows why that is? Why did my upside risk expand here? Who can explain it? And it's not a difficult explanation. It has to do with a single metric that these are using. Kirk says, if you're playing VRP, would it be better to scale by adding less higher delta contracts or more lower delta contracts? That answered by the volatility slope of an options chain. It depends on where you think the skew is most pronounced. A way that you can play something like VRP or skews specifically is to look at where the steepness is. If I go back a day quickly, and we go back to the same time, which was 0830, it should load pretty quick because we were just there. What you can do is plot the slope. Vol, this is term vol. We'll do another version of this. Get rid of this thing. Okay. What we can do is we can look at a different version of this. So we can say within an expiration, we can look at the delta. And we can look at the skew and the steepness. So here we'll start with the 40 put. I'll add a thing for a strike. This way you can compare across calls and puts. We had the 40 put. 40 put was a 5 delta. Total vol there was 58.75. And I'll just do it for the put side here to start, but you could do this for both sides. Then we'll do the 45 put. That is a 10 delta. Vol on that is 0.45, 45.4. Then we have the 50 put. Delta is 0.27. Vol on that, 40.8. And then we have the 55 put. Delta there is 0.54. Vol on that is 0.40. I'm sorry, 40.4. And you can plot this. Then based on this plot, you can find where things look interesting. A is labels good. 58 is good. Here we do not need the delta. We just need the vol. As you can see, there's a more profound change here. And if I normalize this by delta instead, you can see that the further out of the money actually has a much more dramatic peak in the vol, which is very common. You'll normally see this. Now, you don't have to like make your own version of this. Most decent platforms will have a plot for you. It doesn't do it in on demand, but in regular, you can literally look at this specific thing. So if I sort this by out of the money and I go to the term that we're looking at, the 21 Nov, I can literally look at exactly what I just showed you. But we can see that there's a big gap here between the 62.5 and the 65. So those are really rich, but you can also see that there's a wide bid-ask spread. So you're probably not going to get a fill at the mid, which is what this is assuming for this price. A couple different ways you can visualize that. All right, let's go back into on demand. Reese says vol. TCM says because more short puts. Well, if it's because of more short puts, why would my upside risk go up? That doesn't logically flow, does it? What happened, this is the onset of the trade. Our upside risk here was 6,600. But when I fast forwarded one day and I went towards the end of the day to 12:30, we can see that this 6,700 turned into 11.5. Arjun says vol expansion. That's not correct either, although a good guess. This is actually a great question then, since so far we don't have a correct answer. I'll give you guys another minute to guess. I'm going to go grab another seltzer water. I'll be right back. All right, do we have a correct answer? It looks like we still don't. I see Kirk said less put premium to offset the upside loss. That's also incorrect. What's the fundamental change of an options premium? What measures that? Jordan guesses gamma spike, also wrong. Delta. What happened to our deltas? The underlying went up. We had 50 puts, 30 calls. What happened to our deltas? Now you're on the right path. We have less. The short puts lost delta. Now we are correct. Jordan says higher delta. That's incorrect. I understand what you were saying. You're saying on the call side. But let's take a look at what's happened to our net deltas. Here, with 50 and 30, we were net long 454 deltas, right? Let's take a look at what our deltas are now. Let's see what happened. I'm going to move this out of the way so I can update it a little quicker. Our delta for the 50s is now 0.2. And then our delta for the 57 and a halves is 0.4. So what happened? Why did our upside risk change? Because of this. If we take a look at our total deltas, what do you notice? We are now net short deltas. We were net long 450 deltas. The underlying moved in our favor. As the underlying moved in our favor, we lost long deltas on the short puts because they moved further out of the money, posting a profit. And we gained more short deltas from the short calls, which are now closer to the money and are losing more. So what happens is for each subsequent move, we now experience more pain on the short call side because now we're net short between these two positions. It means that if it goes up, we literally lose money. How do we fix this? Reese says it's the business end of gamma. That's correct. So how do we fix this? It's super easy to fix. There's no reason for this to happen. Super easy to fix. Add deltas, that's one way. Who else has a guess? What's another way we could fix it? Lauren's also correct with increased deltas, but what's another way? Offer short puts higher strike. Nope, that's the same thing as adding deltas. Bingo. Jordan has it. Just rebalance. This is the problem a lot of traders have, is they instinctually think that they have to start fighting because it's not doing what we want. Could we start rolling options? Yes. Could we buy or sell shares? Yes. All of that's completely fine. But there's an easier way. Resample the vol. What that means is when we originally put this trade on, we're sampling vol. We're saying this is what vol currently is at the onset of this trade, and then it'll be whatever it will be following. We can literally just resample it. We can say, I'm going to close this position now. And we can track what that will do to us. Our premium on the puts was $1.13. Our premium now is like 92 cents. Our premium on the calls was $1.15. Our premium is now $1.65. What happened here? We have this minus this times our size of 50 gives us 19 points times 100. This one, we have this minus this. So we lose 50 cents times our size, 15 points times 100. What's our net? Up $400. You made money. The instinct that options traders often have is just to fight around whatever is existing. That is keeping your feet in the mud for no reason. You do not have to. If I still believe that there's good risk premium in this trade, all I do is close this position out. I make the $400. And then I rebalance. I now go to the 52.5s and I go to the 60s. That's it. Done and done. You get closest that you can to 30 deltas. And again, just because these deltas, this is another thing that single lot traders are not used to. When you trade in multi-lots, especially larger size, you have really good control over these deltas. So if I wanted these deltas to be 1-to-1, I can make it so. I cannot make it so when I have a smaller position. And I'll show you what I mean. If I sell this option, sell this put, I'll get rid of the old stuff. Lauren says, so you close the whole trade. Why not just close losers? Because the origin for this trade is thinking vol was high. And it was thinking that vol was elevated on the put side in addition to being high. By just closing the losing side of the trade, I'm essentially getting rid of the entire effect that I'm trying to trade. I'm now saying I'm long. I want this to go up. I now have a purely directional position, which is completely different than the intended original onset. It's a good question, but that's exactly why. Let's take a look at my deltas. If I take a look at what my net deltas are here at a one lot, I can see that I'm long 3.5 deltas, which again, in the grand scheme of things, nobody would even bother doing anything about that. That's close enough. Let's amplify this though. Let's move both of these to a 50 lot. At a 50 lot, I'm now long 175 deltas. The way that I can fix this is by selling a few less puts. I can sell a few less calls or a few more calls or a combination of both. But notice that my delta went from being long about 150 and I can make myself effectively flat. I now have negative 0.7 deltas. 70% of a share, single share. That's it. Those are the total deltas on the position. Now, as usual, I have gamma. As soon as this starts, my gamma is going to move. This is why most of the time when traders are doing something like this, we actually focus on flattening gamma and then delta. Because if I go through all this effort to get my delta flat and then the thing moves by a single point, now I'm completely changed immediately. You want to avoid that. The way that you can avoid that is by flattening the gamma first. The trick with that in this scenario is you're short both the options. There is no flattening the gamma. This is your risk. If you're doing something that you're trying to buy, a little bit different of a scenario. This is why short options have this baked in risk, because you can't neutralize your gamma. That's how it goes. There's got to be a trade-off. That's the trade-off. Damn, it's already an hour. Omelet says, if you find that someone placed a synthetic long at a certain strike on ETF like silver, other than just hopping on because of the large volume, how else can you use that to your information? A bunch of things. The first thing is I don't know that it's a synthetic long, which is really, really important to start with. If I see a specific strike that looks like it's built out, meaning there's a lot of money in it for some reason, I normally use that as a jumping off point just for subsequent investigation, looking at stuff a little bit differently. Let's take a look at your SLV example. SLV. What am I doing? I want this. So the 60 strike really is actually super quiet. It doesn't have a ton. Let's see total volume. Yeah, so the 60s in SLV are actually like quite quite quiet. But anyways, let's just pick one, right? Let's say the 65s. Those are still relatively quiet, but let's just say the 65s. There's a series of thoughts that go through my brain, and let's pretend that the 65s were huge, right? Let's say that they're like way up here. I want to know what expiration is that in first. If it's something that's farther out in time, there's less I can do with it. If it's something that's closer in time, it becomes more interesting. Then I want to take a look at how those 60s were built. Was it a couple block trades? Was it something that was being hit over a few days? All of that tells me a lot of information. If it's a series of sweeps that keep consuming all of the open interest or all the offered volume, then that's something being put on pretty urgently for some reason or another. More importantly, I can't deduce if this is a synthetic long. I can't deduce any of that. I have absolutely no idea what the rest of this position. They could be putting on long calls against an insane amount of short stock, for example. And they could actually be net short for all I know. Like, I have no idea. And it's really, really important to acknowledge that, because a lot of times people will try to weave this tapestry of a narrative based on their own paradigm, and it's just completely illogical. That's not trashing you or anything. I'm just saying it's really important to guard against allowing your mind to do that in general, because a lot of times we would think like, oh shit, a bunch of out of the money long calls, it must mean that they're super long or super bullish. And it might not be. We don't know. But that's the starting point. Is that would be a really good jumping off point for that subsequent investigation that I kind of outlined with some of those major muscle movements attached. But as a single data point, it's only a single data point. I really don't think much of that by itself in a vacuum. It really then depends on the rest of the analysis. I want to know, again, the way that that individual strike was built. I want to know what the rest of the option chain looks like. I want to know what the underlying looks like. I would take a look at term structure. Is there a lot of vol there for some reason? That would tell me that some sort of event is coming up that could be expected. There could be some fucking crazy new thing with silver that's expected around then to start driving price. Does that open interest remain, or does it start trickling down if somebody is starting to come out of it? That kind of stuff. Omelet says the 21 Nove 65s, I noticed the other day, Wednesday, had large volume, 53 over 51 at EOD. So I was like, this is very fresh flow. Yeah. And I think that that's like your perception there is good, right? That there's something. But the other thing that we have to acknowledge is really the size of that is tiny. There really just isn't much there. The total amount of volume at that level isn't super profound. So there isn't like an insane amount sitting there, at least as far as I can see. Yeah, like if I look at the 65s, there's certainly some OI, but it's nowhere near what you're seeing at like the 50s or even the 60s. Now, that position being built out, again, could be for a lot of reasons. It could be somebody just rolling a position that was going to expire. It could be adding a position against the rest of a stock portfolio and they actually think it's going to go down, but they're using those long calls as part of a hedge. That's why the rest of the information is so valuable. Any one of these data points really doesn't do a ton for us. But once you use multiple of them, then you can weight the breadth of the evidence and see if there is something a little bit more telling. But those first data points that you see are interesting for sure. No OI there. Something being offered quite a bit above the money. Like that's a starting point for sure. Jeffrey says if you buy shorter term, further out of the money options in higher quantity, can't you neutralize gamma? Like 5 delta at 5x the quantity. You can help with some offset, but we can take a look at the ratio that we would need in order to get the position that you want. The thing that you have to pay attention to there is that, again, like the shape of the position is going to change, because if you have a bunch of, let's say, short puts, and then you want to take out some of the gamma exposure, so then you're buying now short puts that are further out of the money. As soon as things change, then again, you're in kind of the same boat. One of the best ways, and this is why people who trade like risk premium via short premium strategies like straddles or strangles, we normally just set delta bands. And we say, relative to the size of the position, what's the total delta, long or short, that I'm okay with having? And then you just plan to hedge really as frequently as you can, but it's really common to do it, once a day, twice a day, something like that, if it gets outside of bounds, and you just keep flattening stuff like that. And that's also why an important part of the process is to recenter the base position as well. Because if you don't recenter the base position, then you're just having to hedge a bunch more, because now your deltas definitely are super skewed. All right, gang. Time for me to bounce. Enjoy your weekend. Be an outlier. See y'all later.